Today we're doing a complete breakdown of Indian Accounting Standard 103. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before Indian Accounting Standard 103, mergers and acquisitions left financial statements murky and inconsistent. Companies could record assets however they pleased, leading to confusion. Now, every acquisition reflects a consistent, comparable method. Understanding this standard reveals how financial transparency impacts mergers, creating a unified narrative for stakeholders. Indian Accounting Standard 103 exists to solve the problem of inconsistent reporting in business combinations. Before its introduction, companies could report acquisitions in varied ways, causing confusion and mistrust. This standard brought a unified method for recognizing and measuring acquired assets and liabilities, known as the acquisition method. Now, investors and stakeholders can confidently compare financial statements, making informed decisions. Indian Accounting Standard 103 enhances transparency, fostering greater market stability and trust. Indian Accounting Standard 103 is mandatory for all entities involved in business combinations, effective from April 1, 2016. Its cornerstone is the acquisition method, which standardizes how companies recognize and measure acquired entities. This method involves identifying the acquirer, measuring the consideration transferred, and recognizing any goodwill or gain. This requirement ensures financial statements are consistently comparable. Understanding this key requirement is essential for accurately assessing company valuations and conducting financial analysis. The acquisition method under Indian Accounting Standard 103 is like setting a clear baseline for valuing acquired businesses. It requires recognizing all identifiable assets and liabilities at fair value, ensuring transparency. This method also involves calculating goodwill or identifying a gain on bargain purchase, providing a consistent financial narrative. Identifying the acquirer is crucial, influencing the recording and reporting of transactions. Understanding this approach is vital in interviews, demonstrating insight into financial transparency during mergers. Understanding the scope of Indian Accounting Standard 103 is crucial. Candidates often overlook that acquisitions of assets not constituting a business aren't covered by this standard, a mistake that trips up many. Knowing what is included or excluded can make or break your analysis and your interview performance. Indian Accounting Standard 103 applies to acquisitions where an acquirer takes control of businesses, including those under common control. Picture a company buying out a competitor. This transaction falls under the standard's purview. Joint ventures also come into play when they lead to business control, ensuring uniform accounting treatment and comparability. Indian Accounting Standard 103 excludes acquisitions of assets that don't qualify as a business, sidestepping unnecessary complexity. Think of buying a single factory with no operations. It's not covered. Transactions between entities under common control are also out, unless they lead to a business combination. This focus avoids cluttering financial statements with irrelevant details, honing in on changes in control and structure. A business combination involves an acquirer obtaining control over one or more businesses. It's more than just purchasing assets, it changes control dynamics. Consider a major tech company acquiring a startup to enhance its product line. This isn't just an asset grab, it's a strategic maneuver. Such combinations can redefine industries, making accurate financial representation crucial for stakeholders to understand shifts in market power. The acquirer is the entity that gains control in a business combination, pivotal for accounting treatment. Identifying the acquirer ensures accurate financial reporting, especially in corporate takeovers, where the acquiring company dictates the transaction's nature. For example, when a larger company overtakes a smaller competitor, it becomes the acquirer, impacting how assets and goodwill are valued post-acquisition, crucial for stakeholders and strategic planning. Scope edge cases often trip up candidates. Imagine buying properties that lack business operations. Indian Accounting Standard 103 doesn't apply. Internal asset trains among subsidiaries without control change are excluded. However, acquiring an entire division, altering control, qualifies as a business combination. Joint venture restructurings without control change also fall outside scope. Understanding these nuances is key to mastering this standard. Imagine acquiring a company without knowing the true cost or value of the acquisition. The acquisition method under Indian Accounting Standard 103 resolves this by structuring the recognition and measurement of the acquired assets and liabilities, ensuring clarity and consistency. This structured approach is critical for stakeholders to understand the financial implications of a business combination. The acquisition method provides a systematic approach to reporting business combinations. It focuses on identifying the acquirer, determining the acquisition date, and recognizing and measuring assets, liabilities, and goodwill. For this video, we'll follow Meridian Corporation's $10 million SaaS contract, which includes an $8 million software license and $2 million in implementation services, to illustrate each step clearly. Meridian Corporation's acquisition of a $10 million SaaS contract involves determining which party gains control. Here, Meridian Corporation is the acquirer because it controls the software and associated services. A common error is misidentifying the acquirer in complex ownership structures, which can derail proper financial reporting. Indian Accounting Standard requires clear acquirer identification for accurate application of the method. This sets the stage for determining the acquisition date, our next focus. Pinpointing the acquisition date is crucial. It's the moment when Meridian Corporation gains control over the SaaS solution. In our scenario, this is not the signing date, but when control is actually transferred. Mistaking these dates can lead to reporting errors. Indian Accounting Standard specifies that control transfer should define the acquisition date, setting up accurate asset and liability recognition, which we'll address next. Now, Meridian Corporation must recognize and measure the software license and services at fair value. This means the $8 million software is recorded as an asset, and any obligations from the $2 million services are liabilities. A frequent error is not assessing these at fair value, skewing the balance sheet. Indian Accounting Standard mandates fair value measurement as of the acquisition date, paving the way for goodwill or bargain purchase calculations next. Goodwill arises when the price paid exceeds the net value of assets and liabilities acquired. Meridian Corporation's consideration over the $10 million contract determines this premium. Misestimating goodwill by incorrect asset valuation is a typical pitfall. Indian Accounting Standard requires precise calculations to reflect the premium genuinely paid above fair value. This ensures stakeholders see the true value added by the acquisition. Measurement choices in Indian Accounting Standard 103 can reshape your financial landscape. Choose wrong, and you risk misrepresenting your firm's financial health. Imagine an acquisition. Valuing intangible assets high could inflate goodwill, altering key ratios. Let's see how these choices directly impact financial statements and what disclosure is non-negotiable. Initial recognition under Indian Accounting Standard 103 requires all identifiable assets and liabilities to be measured at fair value on the acquisition date. For example, if acquiring a tech startup for $10 million, the identifiable software patents should be recorded at fair value, impacting goodwill calculation. Contingent liabilities enter the balance sheet only when fair value is measurable, ensuring financial accuracy. After initial recording, Indian Accounting Standard 103 mandates annual impairment testing for goodwill, rather than amortization. For example, if your acquired manufacturing unit's goodwill shows impairment indicators, remeasurement can prevent overstatement. Contingent liabilities and consideration are revisited each reporting date, reflecting real-world changes, ensuring the balance sheet mirrors current conditions. In financial statements, goodwill from acquisitions is listed under non-current assets, providing a clear view of intangible asset value. Liabilities acquired are classified by nature, aligning with their settlement terms. Notes reveal acquisition specifics, such as fair value assumptions, enhancing transparency. Costs tied to acquisitions appear in the profit and loss as they occur, offering insight into impact on profitability. Indian Accounting Standard 103 requires disclosing acquisition motives, helping stakeholders understand strategic objectives. Detailing fair values of acquired assets and liabilities aids investor assessments, painting a clearer picture of financial impacts. Goodwill disclosures differentiate between synergies and overpayment, vital for evaluating acquisition wisdom. Reporting on contingent liabilities and their evolution informs on potential future earnings adjustments, ensuring informed decision-making. Imagine CFO Alex overseeing an acquisition, registering $2 million in goodwill, significantly affecting the equity ratio. Annual impairment reveals a $500,000 goodwill write-off, adjusting asset valuation. Fair value adjustments on liabilities post-acquisition alter the balance sheet by $300,000. Meanwhile, contingent consideration revaluation adds a $150,000 expense to the profit and loss, directly affecting current operational results. These actions illustrate real-world financial leadership challenges. Meridian Corporation, a global manufacturing giant, acquires a smaller competitor for $3.5 million. Follow the entire accounting journey of this business combination, from initial recognition to the final disposal of assets. Experience each step of Indian Accounting Standard 103 as it unfolds. The initial recognition captures all acquired assets and liabilities at fair value as per Indian Accounting Standard 103. Goodwill of $500,000 is recognized, representing future economic benefits from the acquisition. This entry ensures Meridian Corporation's balance sheet reflects the true value of the acquired business. Meridian allocates the purchase price of $3.5 million among various assets. Inventory is valued at $700,000, PP&E at $1,300,000, and intangibles at $500,000. Adjusting goodwill ensures each asset is reported accurately, complying with Indian Accounting Standards' emphasis on fair value allocation. An impairment test reveals that the carrying amount of goodwill exceeds its recoverable amount by $100,000. Indian Accounting Standard 103 requires recognizing this impairment loss immediately. The adjustment ensures Meridian's financials remain conservative and reliable, avoiding overstated asset values. Amortizing intangible assets at $50,000 each period reflects the consumption of economic benefits. Under Indian Accounting Standard, systematic amortization aligns expenses with revenue generation, ensuring the income statement accurately reflects current profitability. Consolidating subsidiary financials involves combining assets, liabilities, and results. An adjustment to retained earnings reflecting the investment value is critical under Indian Accounting Standard to present a unified financial picture, aiding stakeholders in assessing Meridian's overall financial health. Selling an asset component for $200,000 that was carried at $150,000 results in an $80,000 gain. Indian Accounting Standard requires recognizing this gain to reflect true financial performance. The disposal impacts net income, enhancing Meridian's profitability for the period. The final derecognition involves disposing of residual assets and settling liabilities. Recognizing a $100,000 loss reflects the net effect of disposal under Indian Accounting Standard. This closure ensures Meridian's balance sheet no longer reflects the acquired subsidiary's financials, marking the end of this acquisition journey. Every Big Four and investment bank interview on Indian Accounting Standard 103 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. A business combination is a transaction where an acquirer gains control over one or more businesses. Under Indian Accounting Standard 103, this involves identifying the acquirer, measuring the cost, and recognizing any goodwill or gain from a bargain purchase. The common mistake is misidentifying control, which impacts financials. Remember, control is the power to direct activities that significantly affect returns. The acquisition method is used because it provides a clear framework for valuing acquired assets and liabilities, ensuring transparency. Indian Accounting Standard 103 mandates identifying the acquirer, measuring the consideration transferred, and recognizing assets and liabilities at fair value. Common pitfalls include neglecting fair value adjustments. Key takeaway: fair value provides accurate financial representations. Goodwill is the excess of the consideration transferred over the fair value of net identifiable assets acquired. Indian Accounting Standard 103 requires this to be recognized as an asset. A common mistake involves calculation errors or ignoring contingent liabilities. Remember, goodwill reflects potential future economic benefits that are not individually identified. Non-controlling interests can be measured either at fair value or at the proportionate share of the acquiree's identifiable net assets. Indian Accounting Standard 103 allows both, but the method chosen affects subsequent financial analysis. A common trap is overlooking this choice's impact on reported earnings. Key point: the method chosen affects net income distribution. The acquisition date is when the acquirer obtains control of the acquiree, while the transaction date is when a purchase agreement is signed. Misunderstanding these can lead to incorrect timing of asset and liability recognition. Key takeaway: financial effects should be recognized on the acquisition date, not the transaction date. Indian Accounting Standard 103 follows International Financial Reporting Standards 3 closely, but includes additional guidance for business combinations under common control, which International Financial Reporting Standards lacks. Another difference is in the accounting for contingent consideration. Candidates often overlook these variations, affecting transaction structuring. Remember, always check for specific guidance under Indian regulations. To calculate the fair value, use market-based valuations or present value techniques for assets lacking active markets. Indian Accounting Standard 103 emphasizes fair value to ensure accurate financial reporting. Common errors include inappropriate valuation models. The takeaway: choose valuation methods that reflect current market conditions for accurate asset representation. Indian Accounting Standard 103 covers transactions where an entity gains control over one or more businesses. It excludes asset acquisitions and joint ventures. Misunderstanding arises when candidates wrongly applied business combination rules to these exclusions. Critical reminder: only transactions resulting in control over businesses fall under Indian Accounting Standard 103's purview. Disclosure requirements include details on the acquisition date, the cost of the combination, and a description of the acquired assets and liabilities. Indian Accounting Standard 103 emphasizes transparency to inform stakeholders. The mistake is often under-disclosure, leading to compliance issues. Remember, comprehensive disclosures ensure informed decision-making by investors. A common trap is misinterpreting control, equating it solely with ownership percentage. Indian Accounting Standard 103 defines control as the power to direct relevant activities. This can exist without majority ownership, for example with contractual arrangements. The takeaway: always evaluate control based on decision-making power, not just equity ownership. Indian Accounting Standard 103 is all about making financial reporting clear and comparable when businesses combine. It covers nearly all combinations, focusing on who's acquiring, who's being acquired, and what control really looks like. Goodwill emerges as the future benefits from things you can't individually tag. This standard is your guide to understanding these essentials in mergers and acquisitions. Unlock the intricacies of the acquisition method, where the acquirer's identity and the timing are everything. Fair value takes center stage for assets and liabilities, while goodwill or a bargain purchase reflects the deal's essence. Non-controlling interests offer measurement choices, and intangible assets get their own spotlight. Even contingent liabilities find their place, marking the complexity of the acquisition landscape. In interviews, watch for traps like misidentifying the acquirer. It can skew results dramatically. While Indian Accounting Standard 103 shares core principles with International Financial Reporting Standards 3, nuances exist. Disclosures must be thorough, covering every asset and liability detail. Be ready to explain common control exclusions and the intricacies of reverse acquisitions. Step acquisitions and provisional amounts add layers to your understanding, crucial for real-world application. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.